So what do we learn from the actual fundamentals here in terms of what this company is saying with all the coronavirus fears that are in the backdrop?
Hey, Oliver, thanks for having me on. I think the story here is that fundamentals were very strong going into 2020. 19 had a strong finish. Q4 results beat our expectations, and the company was in a record booked position at record pricing. And it's unfortunate that not only is the human toll unfortunate, but it's unfortunate for Norwegian, which has been benefiting from so much momentum operationally, to have this virus create some amount of question as to what 2020 could look like. The company's anticipating a 75-cent negative impact to adjusted EPS in the year, but leaving the door open to fluctuations given how fluid the situation is.
So this is interesting. I mean, look, Norwegian, to your point, had already been doing a lot to try and build some scale, build some quality in a very competitive market where cruise lines have, bought other ships, they've upgraded their ships. So this is kind of like the worst timing in a way.
It's unfortunate timing, but as we've said before, Norwegian benefits from predominantly North American exposure, and we think that that could help provide some support throughout the year. As globally, we may see some weakening demand for cruise in general, but that mix of revenue sourcing being heavily North American weighted, I think, could help them weather this okay, despite the fact that, of course, they are warning of a negative impact, and we are certainly taking that seriously.
How do we gauge the potential for their guidance to hit on the target that they're giving? Because right now we have really just everybody's kind of in the dark, Paul. Whether economists and traders, everybody, strategists, just kind of speculating, generally assuming that the slowdown is going to happen, but unclear what the real toll is going to be. So, do we have any idea what sort of the quantitative, explanation is for Norwegian's guidance? Do they say?
That's a fair point, Oliver. I think the positive that we can take from this perspective that Norwegian has given us in this result is that their estimate is through third quarter end, when the peers have been giving estimates with an April end impact. And so with a longer term view, as well as a proactive effort to reposition, redeploy through that third quarter end period, I think the Norwegian window being longer helps us as investors understand their view and their perspective and their vantage point in estimating this.
Right now, Paul, among the big three, Carnival, RCL, and Norwegian, it sounds like you like Norwegian. What about the peers? I mean, the trading action looks pretty darn similar between most of them. I mean, RCL basically looks exactly like Norwegian on the chart.
I'm bullish on fundamentals and just the improvements in the overall cruise industry across the peer group. But when we look at the guidance that's been given by RCL and CCL, for example, I mean, I think it's very hard to tell what the true outcome and impact is going to be, given that, when we had the RCL result, there was a 25-cent impact flagged on 8 cancellations, and then this jumped to 65 cents that they put out in a press release most recently on 18 canceled voyages, flagging an additional potential 55 cents if the situation continues as is through end of April. I think it's very tough to quantify at the moment what the peer group could look like given the volatility of the situation.
The overall kind of outlook here, given the investments that Norwegian's made, the overall trends that you're talking about here kind of structurally prior to coronavirus, Do they need to have a solid macro backdrop? How do cruise lines fit in terms of the spectrum of premium product to middle of the road service? Do you need to see the robust backdrop in the U.S. economy for these companies to see the fruits of their labor pay off, or can you have a little chop in the economy? Where do they sit along that spectrum?
I think having a strong consumer macro backdrop is always important for lifestyle and leisure stocks like these. I think given the long view on bookings for something like cruise lines, it's such a long window that in fact it may give us some insight into what consumers are thinking and feeling ahead of time. I think the booked position for all, the Norwegian results so far, and continuing to say that despite Corona, although that might change, I think that gives some positive read-through into what the consumer picture could look like. But it is important to note that a strong consumer macro backdrop does matter for these stocks.
Yeah, all right, really good stuff, Paul. Appreciate the update here as we get ready to do a little trading here. Tom White, thank you, Paul Golding, joining us from Macquarie. Tom, let's do the sort of bullish tilt here on Norwegian, all right? Let's say these fears abate. Backdrop here has been positive coming into this, according to Paul. How would you trade that bullish sympathy?
Well, I think you want to give yourself duration, a little bit more time than you normally would if you want to take that bullish type stance. Now, implied volatility is getting crushed this morning, even though the stock's down a little bit post-earnings. It's right above that $50 level, which has been a pretty good base for Norwegian in the past. So I looked at that, and then you going out to the June series, basically in the option market. Okay. That's about 4 months until expiration here.
So you're buying a spread here, call spread.
Yeah, call spread.
Wide.
It is pretty wide, and you're buying the 50 strike call in June, which is currently at the money, which I typically like to do when I'm buying directional verticals, and then selling the 57.5 strike call against that to reduce some costs in this trade, Oliver. And you pay roughly about $2.90 debit, so you're getting long Norwegian over the next 4 months, and that takes that break even up to $52.90 to the upside. So you need a move of just over $2.50 from current share levels to make this trade profitable at expiration. Okay. But what I like the setup on this is you're buying lower implied volatility because the news is already out on it, with the expectations that, hey, they're going to get a hold of this coronavirus, and you're going to start seeing some better metrics and better guidance out of some of these companies. So this is a way to play it, really inexpensive way, instead of buying the shares outright, to take a directionally bullish stance on Norwegian post those results. With that, you need it above that 52.90 level over the next 4 months.
All right. Now, on the flip side, because I know there's going to be people watching going, hey, this thing's a way bigger problem than anybody's giving credit for. Right. We saw the flare-up of cases in Korea overnight. That's not good. Right. But thankfully, we've got an underperformer in the cruise line space, as we saw very obviously on the chart. Let's do a bearish trade, kind of, a little bit more neutral on CCL.
CCL, so yeah, this one's been hit a little bit more, and that's probably due to the fact that cruise ship off the coast of Yokohama was Carnival Cruise Lines. Yeah, exactly. So what I looked at, stock's trading around 42.5 right now. I created a short iron condor with a common strike at that 42.5, where you're selling the call and the put on the 42.5 strike. But selling that straddle at the 42.5 strike in the March cycle. So this is really more short-term, 29 days to expiration, because on the 24th of March, CCL reports earnings. So I want to kind of avoid that earnings event. And then I'm buying the 37.5 strike put and buying the 47.5 strike call to the upside to make it risk-defined. You can see there at the tails, Oliver, that you're still risk-defined. $5 wide on each wing of this iron butterfly, we like to call it sometimes, where I'm collecting $2.80 credit. I've got a risk of $2.20 on either side if it goes above or below those break evens of $39.70 and $45.30 on the upside. So you've got a nice wide range for this thing to trade between over the next month. And you avoid earnings. I think that's key, because implied volatility in CCL, because of the 15% drop that we've seen so far this year, it's really elevated, which allows you to collect more credits on strategies like this.
All right, nicely done, Tom White. Thanks again to Paul Golding joining us from Macquarie. Really good stuff here on an important group to watch.